Thanks very much, Juliet. Let's take a look at the markets. Asian markets were mixed, with Tokyo's Nikkei jumping to its highest level since January. China and Hong Kong markets closed on a downer. This was partly on the back of a weaker dollar, which is said to have touched a 3-year low against its trading partner currencies. Market players were also said to be digesting Donald Trump's threat of selecting a replacement for US Fed Chair Jerome Powell earlier than expected. This after Powell suggested that part of the reason why interest rates had not been cut further was because of Trump's tariff policy. Trump has been urging the US Fed to cut rates more rapidly than it has. The Nikkei share average ended up 1.65%. The Hang Seng Index declined by 0.61%, while the Shanghai Composite Index closed in the red, down 0.22%. US markets were fairly subdued at yesterday's close, although maintaining the gains made in the 2 previous sessions, with the exception of the tech index, which was up partly on the back of Nvidia hitting a market cap high of $3.8 trillion. Investors were taking note of the continued testimony of US Fed Chair Jerome Powell, while also keeping their eye out for the Israel and Iran's fragile ceasefire, which even President Donald Trump has said the length of which can't be guaranteed. The Dow Jones Industrial Average declined by 0.5%. The S&P 500 closed down 0.02%, while the tech-heavy Nasdaq rose by 1/3%. Well, thankfully, Juliet did manage to give us those indicators at the top of the hour, so we'll get straight into our interview with Muhammed Wagley. He is from Sasfin Wealth. Thank you so much, Muhammed, for joining us. So just give us a sense of what you're seeing in terms of what Jerome Powell had to say. He's been talking to Congress over the past number of days, saying that if Donald Trump hadn't come up with his very interesting tariff policy, that he would have cut interest rates. I'm sure Donald Trump was not happy to hear that, but it's a fair point, right?
Yeah, well, I think Donald Trump not being happy to hear that is probably the understatement of the century. I think a lot of the Republican right-leaning politicians feel very much the same way. But it's not unfair, truth be told. You know, we haven't, as of now, got sort of those well-defined tariffs, perhaps in the way that President Trump wanted to implement them, just in the sense, you know, that there's been so much back and forth in that, like, he'll come out with a tariff today, and then tomorrow the relevant country affected will sort of negotiate, and then, you know, it's not nearly as bad as it would have been. So in that sense, we haven't actually seen a massive impact on the data from the tariffs. Now, this is still sort of a developing story, and I imagine we'll see an evolution in that going forward. But as of yet, you know, there hasn't necessarily been an impact. Now, what is relevant is that the threat of the tariffs has actually caused massive uncertainty pretty much across the board. You know, the question that's been keeping sort of investors up at night, making them nervous, is, you know, to what extent will those tariffs negatively impact inflation? We know that it will negatively impact inflation, but to what extent will that be? You know, managing inflation is obviously a massively key priority for the Fed. And I think from this perspective, it does make sense, you know, Mr. Powell's comments. Now, again, the Republicans are not really happy with these comments. They've accused him of bias. But, you know, if I look back sort of across his tenure, I don't really think he's changed his tact too much. You know, the Fed has been quite deliberate, quite methodical, you know, in their data-driven approach throughout Mr. Powell's tenure. I don't think this is going to change. You know, I imagine we'll continue to see this going forward as this tariff story develops, you know, because over the past 2 weeks, the narrative has revolved around, you know, what's been going on in the Middle East. But, you know, tariffs are going to come back into sort of focus going forward. And I imagine will remain the story going forward this year.
So tech counters, they continue to look solid despite all the drama that's been going on. We saw that the Nvidia share hit a market cap of $3.8 trillion, but there's always been that conversation going on around whether we're going to see a correction on the tech stocks because their valuations are deemed to be quite high.
Yeah, well, I think, you know, sort of common logic dictates that what goes up must come down, you know, and I think that's really where we see the discourse around corrections come in. But you know what, corrections are part of the game, and I think people sort of don't price that in enough. You know, I think often enough people conflate them with crashes, but even the best performing shares have periods where they are, you know, for at least in the short term, coming down, and I would say that those corrections, at least with reference to these massive blue chip companies, you mentioned Nvidia, like as long as the quality is there, those corrections offer opportunities to get more of the share at relatively attractive prices. Now, in the case of something like Nvidia, unless you're of the opinion that, AI is a bit of a hoax, it's just not going to do what people think it's going to do, there really isn't a reason to maybe even consider selling these guys, at least from an investment perspective, So I would definitely look to sort of add at relatively attractive prices if given the opportunity through corrections, especially within the case of something like Nvidia. But just to address your point on valuation, it's true these guys are expensive. A lot of these tech companies have so much growth priced in, and to a large extent, always are quite expensive. The question is whether or not they can keep delivering, which would then convince the market that the growth that's being priced in is either sort of unfair or unwarranted or warranted. Broadly speaking, going through Nvidia's results every quarter, every time the company sort of has something material to say, that's actually what we're seeing, that they do keep delivering, and from that perspective, it's definitely not a company I'd be looking to bet against anytime soon.
Yeah. Muhammed, because of time, I just wanted to ask you one specific question around South Africa. The Reserve Bank has released a quarterly bulletin speaking to all the different variables that run the economy of the country, growth, expenditure, and so on and so forth. But what is your sense around investor confidence in investing in South Africa?
Yeah, okay. So just for a bit of context, this is the economy, or the South African economy, the way the Reserve Bank sees it, how it sees it evolving, what are the trends affecting us, what are some of the hard numbers, and I'll sort of start there. What we're really seeing here is a bit of a stagnation in growth, at least with reference to the first quarter of the year. And, that's not necessarily too much of a surprise, but, to sum it up, really, the economy is treading water. I don't think that's too much of a surprise. There are some isolated bright spots in agriculture, services, and I think people are looking quite positively at commodities, with specific reference to platinum, maybe a little bit of gold as well. But, broader structural issues are still weighing on us quite heavily. The growth just isn't there. And so even though we're looking at a all share that's near or at all-time highs, that's just a part of the picture. The truth is, the South African consumer is still quite struggling, with reference to what the political analyst, Mr. Mzondile, was talking about earlier. There's, a bit of chaos, perhaps that's too loaded a term, but there's a bit of movement, in relation to the GNU, some uncertainty there. And, investors are looking upon the economy with, if it's optimism, it's very, very cautious optimism. And that is with predominantly directed at certain sectors, the ones I mentioned being some of the commodities, really just your platinums and your gold, So I would say, broadly speaking, we're seeing quite a bit of cautiousness here, and that is due to those structural challenges. Energy reliability remains an issue. There are question marks in relation to the infrastructure bounce back, and these things continue to plague us. I think the market is watching very closely for signs of reform, signs of infrastructure stabilization, and before we get that, it's really tough to sort of pinpoint that we're heading in the right direction. And to that extent, it's also tough to sort of confirm that we're going down further, so we are in a bit of limbo right now. That's in a nutshell what I'd say.
All right, thank you so much for your time and insights. As always, that was Muhammed Wagley. He's a portfolio manager at Sasfin Wealth.